As a MedSpa owner, do rising tax bills and last-minute payment headaches sound all too familiar? You're not alone. This video has the answers you've been looking for. Why is this happening? It's simple. You're not tax planning. You've put all your trust in your bookkeeper, CPA, accountant, controller, tax attorney, grandma, mother-in-law, thinking they've got your back. They probably want to, but deep down inside, you feel that something's off. Your instincts are absolutely right. You are overpaying in taxes. In this video, I'm gonna show you 7 straightforward strategies to stop overpaying and cut your next tax bill by at least 35%. Let's dive in. As a CFO, I've been working with hundreds of business owners over the last 20 years and helping their businesses scale and grow and save money on taxes. And I can tell you, last year alone, tax liabilities have been the highest they've been in years, and there's no signs of that changing. In fact, the largest, most influential tax reform bill, the Tax Cut and Jobs Act, which was signed into law in 2017 and put into effect for the 2019 tax year, is being reversed altogether. And to make matters worse, the IRS just got an additional $80 billion in funding to take more money out of your pocket. As a MedSpa, you're already struggling with oversaturation in your market, with a new MedSpa opening down the street every other week, other month. You're struggling to stand out despite investing thousands of dollars in marketing and advertising, resorting maybe to ongoing promotions, which are eating away at your margins. That's not going to stop. The MedSpa industry is growing at a rapid pace. It is expected to become a $59.4 billion industry within the next 5 years alone. It's exciting, really, if you think about it. It's a wonderful time to be in the space. But this has caught the attention of private equity firms, which are moving fast and creating further competitive pressure on standalone med spas like yours. If you think it's hard now to compete with a med spa down the street, imagine having to compete with a Wall Street private equity firm. They've got the power of economies of scale at their disposal. They're going to have way more money and way more resources to poach your employees, and patients will follow. You cannot afford to continue entrusting your bookkeeper or your CPA, or in some cases, maybe even your tax attorney, whoever you're working with, just so that you wind up paying the IRS more money than you need to on taxes from your hard-earned profit. This needs to stop. The money you're giving away to the IRS should be going back into your business so that you can get ahead of the curve and you don't just focus on surviving, but scaling, growing, and thriving. Listen, I'm sure your bookkeeper, your accountant, your CPA, your tax attorney, whomever, is a great person. They might be your in-law, they might be your best friend. You may have known them forever. They might be your mom's best friend. They might even be your mom. But guess what? Your bookkeeper is focused on using traditional accounting methods that have gone unchanged in the last 150 years. And it's pigeonholing you into strict standards meant for publicly traded companies, not a privately owned med spa. And on the other hand, your CPA, your tax preparer, your tax attorney is solely focused on compliance with the IRS, because an audit means more work for them that they don't really want to do. They're in the business of volume. The more returns they handle during the tax season, the more time they get to play golf. None of these people look at your med spa through a strategic lens with surgical precision to save you money on taxes. Bottom line, good news for you, I don't play golf. As a CFO, I focus on what's beneath the surface. The IRS has hundreds of tax strategies available for your business to use, designed specifically to stimulate the economy. These are tax credits and deductions meant to lower your tax bill. But believe it or not, less than 5% of businesses that generate $1 million or more in revenue actually take advantage of them. To make the most out of these strategies, it isn't really just about writing off deductions and burying your personal expenses into your business after the year has passed. Many require actual implementation in the business, changing up accounting processes. This could mean the difference between you having to expense an additional $100,000 in your business versus making your business $100,000 more profitable and adding little to no tax on that profitability legally. If you want to scale and grow your med spa to its fullest potential and not pay taxes out of the wazoo, then listen closely. Tax strategies will allow you to show your business's true profitability while decreasing the taxes you owe on that profitability at the corporate or individual level, depending on how your business is structured. We will talk about how the structure of your business plays a key role in that later. So, when you ask your banker for a loan for your next MedSpa location and you have to show your tax return, it actually reflects your true numbers and profitability. Imagine that. Every week, I speak with at least 5 MedSpa owners who are profitable and fast-growing businesses. And most of them, unfortunately, are overpaying on their taxes simply because their CPA tells them that's what their tax bill's supposed to be. And you, on the other hand, justify this by saying, I'm just paying my fair share. Meanwhile, you have to scramble to get the funds together to pay that tax bill come tax time. And you feel like you have to give away a piece of your liver every time you pay your tax bill. By the way, the IRS told me to tell you they are madly in love with you and keep doing what you're doing. Look. On the one hand, you may be the med spa owner who has multiple med spas. On the other, maybe you have a partnership in another business or in your own personal name. Or you might even be a physician who receives professional 1099s. Or you might even serve as a medical director somewhere. You may even have a minority interest in an ice cream shop, for all I know. Because, once an entrepreneur, always an entrepreneur, right? You're getting hammered at the end of the day in self-employment taxes because you don't have the right guidance on the one hand, because your CPA is who you're relying on and they're not focused on tax planning. Therefore, you end up filing an extension to buy more time and avoid paying that big bad bill and ultimately pay thousands of dollars in interest to the IRS for that extension. Sound familiar? Let me show you an example of why you cannot keep making these costly mistakes and you need to implement tax strategies designed for you and your med spa. I'm going to show you in this video today a real live example of a med spa client who was working with us, and before working with us, I should say, was working with a prestigious CPA firm in Philadelphia, Pennsylvania for over 5 years. He thought he was getting the best quality of care, and it wasn't until a personal medical emergency presented itself that he no longer had the funds to pay for his tax bill that he started questioning why his bill was so high in the first place. Here's what that client's liabilities were with that CPA firm at this level of revenue. And here is at a similar level of revenue what his tax bill was while working with us. He was overpaying every year literally by thousands of dollars because his fancy CPA firm was just preparing his taxes the same way you would yourself on TurboTax. Zero tax planning, zero strategy. That plug in numbers, check the boxes, the one size fits all approach is costing so many med spas hundreds of thousands of dollars in overpaid taxes. Stop relying on your CPA and take control of your tax return by controlling the tax strategies that you're implementing. I'm going to show you 7 tax strategies that are going to help you stop overpaying on taxes, but even more importantly, are going to make you money. I've implemented hundreds of tax plans with strategies not only impacting, but almost always saving my clients no less than 35%. And that's just a conservative number. Let's dive into them. The first of the 7 tax planning strategies is entity optimization. Entity optimization is nothing more than a legal structure audit or review. Identifying, reviewing how you own what you own. Maybe it's one med spa, maybe it's multiple med spas, maybe it's one partnership, maybe it's a 100% solely owned med spa, a partnership in another med spa, or maybe you have a partnership interest or a minority stake in another business that has nothing to do with a med spa. And how a management company can serve as the bridge between the K1 that you're receiving from all of the businesses that you have an interest in, and you being able to open the doors of tax planning strategy implementation at your management company level that you own 100% of. So therefore, instead of you getting those K1s, your management company gets those K1s. And in your management company, maybe we set up S Corp election, we start paying you on payroll from your management company, and we incorporate some of these other tax planning strategies that I'm going to deep dive into right now. My next favorite strategy is compensation optimization. Compensation optimization, similar to entity optimization, is a concept in and of itself. It's not really a singular strategy. What you'll also find is that this is completely outside of the domain of competence of a typical CPA, tax preparer, or tax attorney. The idea behind compensation optimization is creating a definable structure behind how you take money out of the business for the purposes of saving money on taxes. Instead of taking money out of the business in irregular form, ultimately doing the accounting, if you will, of everything that you took out of the business over the course of the year and having to pay taxes on that, you flip the script. With implementation of compensation optimization, especially if we're going to leverage this inside of your management company that we've elected to become an S Corp for, we can say, well, if you're taking $100,000 or have been taking $100,000 out of your business consistently for the last maybe 2 or 3 years, let's work with that $100,000. But instead of paying taxes on all of that $100,000, we're going to work on $100,000 as the number that we need to bridge the gap on. And let's start with compensation, officer compensation specifically for a portion of that $100,000. So let's use an example. Maybe we'll put ourselves at anywhere between $25,000 to or $50,000, a range like that. Very conservative on payroll. The first great news about this is your business is 100% eligible to deduct your payroll as an officer of your management company as a business expense. That's the first thing. The second thing is you're going to pay payroll taxes like any other employee would on that $25,000 to $50,000 on payroll. Oh, and by the way, there is no greater way of reducing your probability of getting audited by the IRS than putting yourself on payroll. And that in and of itself could be a significant game changer. And so the question is, or the overall strategy is, how do I get the same $100,000 that I've been consistently distributing from my MedSpa over the last few years while reducing my taxes on that $100,000? Well, we've already covered you taking $50,000 on payroll. Great. Now let's talk about the other $50,000 that you need. We can potentially take that other $50,000 completely tax-free out of the business. Allow me to show you. So if we were to use an accountable reimbursement plan, we could structure expense reimbursement to you for eligible business expenses in the form of tax-free income to you as an employee of your own company, of your own S Corp. So what would be the material ways that we would execute on this? Well, one of the most easy to understand, but most meticulous to implement is the accountable reimbursement plan. The accountable reimbursement plan in a nutshell is defining in the payroll for you, in your payroll, defining what are benefits that are included to you as an employee of your business. For example, we can give you a stipend or reimbursement for cell phone expenses, for fuel, for tolls and parking, for the use of your home office, utilities, electric, cell phone, water, gas, you name it. All of these need to be structured, documented, and formally processed. But if it's done in a structured, documented, and formally processed manner, we can maximize the accountable reimbursement plan with a defined benefit that's outlined in writing for all employees of your management company, where we can effectively distribute to you tax-free reimbursement for eligible business expenses to the tune of dozens of thousands of dollars in tax savings. So here's one strategy that you're very likely overlooking that can save you thousands of dollars in taxes while at the same time giving you tax-free income. What I love about the Augusta rule is that it's one of those strategies that's designed around how do I take the profits of my business and put them legally in my pocket while not paying the IRS. So to take advantage of the Augusta rule, you want to rent your home or your residence to your business. So let's say you validated the going market rate and let's give it a number. Let's say it's $1,000 a day. Well, you can't rent your property to your business for 365 days out of the year. In fact, you can only rent it according to the code, the IRS code, 14 non-consecutive days. So that means that you need to plan your year out ahead of time, or at least that's the process that we like implementing for our MedSpa clients. We want to map out 14 days that remain in the current calendar year and start creating those bills on the business that are payables to whoever's renting the space for the business to hold meetings, whether they're monthly or quarterly partner meetings. There could be employee recognition meetings. They could be, debriefings. They could be anything. You can do whatever you want. At the end of the day, it's your business, but we need to have documentation. The documentation is, like we talked about, we want to do market research for the going rate, make sure that we're charging the rate that the market can support for the property for a full day of renting it to the business for whatever business activity. You want to have notes or minutes of the meetings where the purpose of said day that the home was rented to the business, or I should say that the business rented the property. What did the business rent the property for? Have that documented. You need to have a short-term lease agreement. So now that we have those qualifying things in place and we have the documentation to support it in place, we are able to take advantage of up to 14 non-consecutive days at a rate of $1,000, for example. That's $14,000 in tax-free income. You can bill your business, receive it individually into your personal checking account, and not report it as income. And it's completely legal, and it's a super easy way to get tax-free income out of your business. Hiring kids. This is a tax-free income tax planning strategy. So like the Augusta rule, this is a strategy that allows you to take money out of the business and not have any taxable tax liabilities on this income. So what is hiring kids? It's literally what it sounds like. You put your child on payroll, and there are always qualifiers per the IRS. At this time, the IRS says your child should be at the lower band, 6 or 7 years of age. And this example applies to children that are no older than age 16, because once they hit 17, things do get a little bit tricky. Between 6 and 7 years of age and 16 at the highest, this is what you do. First and foremost, you want to find a task that your child is eligible to do. Every child is different. Every child has different strengths. So maybe it's shredding paper. Maybe it's not. Maybe it's doing digital tasks. Maybe it's taking pictures of things. Maybe it's putting things in the trash, cleaning things. Whatever it is, give your child a task and have them do it. It's good for them, and it's going to be good for their pocket and your pocket at the end of the year. Once you've done that, you definitely want to keep track of the time that they're working. Maybe you create a Google sheet, and if your child is old enough, have them manage that Google sheet. When they came to work, when they clocked in, when they clocked out, because you do need to have compliance. It doesn't matter how old your child is. You need to be prepared for the IRS to come knocking around and asking you, show me the clock in and the clock out log. Having said that, you can, at this time, just under $14,000 a year is the dollar amount that you can pay your child income tax free. And it's as simple as writing a check from the business and depositing it into a personal account. It could be in your name, it could be joint with them, it could be a student checking or savings, or it could be a minor's savings account, a UTMA or a UGMA account. Any bank will open it up for you online, and that's a fantastic way of you taking up to just under 14 grand at this time out of your business, income tax free, and putting it into a savings account for your child. Tax deferred compensation. Let's call it what it is, saving for your retirement. This one is really one that's close to my heart because number one, I take advantage of this for myself, and I have a wealth management background before establishing FCF Consulting Partners. So here's something I'm gonna mention. Saving for retirement or deferred compensation is a 1-2 punch. For a profitable MedSpa that has maxed out on all these other strategies, now it's time to take money off the table, but where do you put it? Obviously, we don't want to give it to Uncle Sam, but where else do you put it? Well, deferred compensation is compensation, and therefore it's an expense on your P&L that you're paying yourself, but you don't pay taxes on that money that you're paying yourself now because we're deferring it until a later point in time, and you'll pay taxes later. Now, there are different ways to take advantage of deferred compensation or retirement, but for the sake of this explanation, we talk about the 401k, traditional and solo 401k. So if you can choose where you can put the most amount of money when you have a highly profitable year, 401k is going to be the master by design. At this time, you can contribute as a single individual under the age of 55, just under $67,000 in just 1 year alone. That's $67,000 of net profit that disappears from your P&L, but you will never pay corporate taxes on it, but you won't pay personal income taxes on it either. So fantastic, very powerful. And if you're married, you can take this just under $67,000 and double it for you and your spouse. If you want to participate in a traditional 401k, come one, come all. All your employees can participate, and at the end of the year, you have the option of paying yourself a bonus or your spouse a bonus or your employees a bonus. And what better way as a business owner to keep your employees happy, you being one of them, than to invest back into your employees, invest back into your business. And when given the option, would you rather give that bonus by making an additional donation to the IRS or give it to your employees, you being one of them? So depreciation. Depreciation is one of those tax planning strategies that is often overlooked because as MedSpa owners, we assume that our CPA or a tax preparer is depreciating our assets, right? And that's fine, but having a proactive perspective on depreciation is what the tax planning strategy is really about. Not just buying a mind ray ultrasound system because you went to a conference or a symposium, or you bought a hydrofacial syndio and just depreciate it over time. Not necessarily. You want to be proactive about buying that mind ray ultrasound or buying that hydrofacial syndio. And the way to do that is having, number one, working with a firm like ours, having a sense of what is your projected tax liability going to be for the year. Should you be looking at buying equipment? And if rather this is an impulse buy and not a strategic buy, which is of course what we want most of our med spa owners to be in a position to do, make strategic buys. With a strategic buy, you can now say, okay, I want to take a bonus depreciation, section 179, and write off up to 80% of the life use of this piece of equipment in addition to the expense of having bought it. Or maybe you just financed it because they offer in-house financing as well. But you can take the bonus depreciation, write off up to 80% of the purchase of this equipment now and not pay tax to the IRS, or spread the depreciation and pay an unnecessary amount of taxes to the IRS now. No, you need that money because you just bought this machine and you're trying to pay it down and pay it off. So take the bonus depreciation now. So section 179, bonus depreciation, is a critical piece of working with med spas and developing their tax plan because it helps us work with their cash flow, improve their cash flow, directing purchases and being strategic about them as they're expanding and adding additional services to be at the forefront of the service providers in the space. And then you can also talk about things like the business owner's vehicle. Are you approaching the end of the year and do you see that there's a projected tax liability? What do we do? Do we give that money to the IRS or do you buy another company vehicle? Or do you change your car by that excuse me, and take advantage of the section 179 bonus depreciation if that vehicle meets the guidelines to take advantage of the section 179 bonus depreciation. So you can easily find yourself in a position where you say, well, Ray, you're telling me I can either give the IRS $100,000 this year, or I can go buy myself a new Range Rover and not give the IRS a penny? Yeah, I think we both know where you're going to lead with that one. So depreciation, it's not one of those tax planning strategies that's a one all end all be all for everyone, but for med spas that are growing, they're scaling, they're highly profitable, depreciation is something to keep at the top of mind, and we keep it at the top of mind for our tax planning strategies. I know that was a lot and it sounds complex. The truth is, it is. There's a lot of supporting documentation and accounting that goes into making these strategies a reality because no one looks good in a jumpsuit. That's just 7 of dozens of tax planning strategies that exist. And the more successful your med spa is, the more advanced these tax strategies are going to need to get. Knowing which are worth pursuing is key. And if you're still watching, chances are you've never discussed any of this with your CPA or tax preparer on one hand. And on the other hand, your bookkeeper and your controller doesn't have the business expertise to connect these dots. That's why you need a CFO's approach. And that's the gap we're here to fill, to save you money on taxes and increase your bottom line, setting your med spa up for future success. So you can know with confidence that you beat the IRS at their game while still playing by their rules. There's no reason for you to pay more than you need to in taxes. You'll also know what your tax bill is going to be on a quarterly basis and funded monthly for peace of mind and no more last-minute scrambling. You'll prioritize paying yourself as a hard-working practitioner injector and still pay less in taxes. Have the money to pay your tax bill ahead of schedule, sitting in an account. Imagine that well before the deadline. No more tax extension filing, which by the way, accrues interest payable to Uncle Sam. So stop thinking of taxes as an afterthought and instead begin thinking of incorporating it into your business as a strategy, as part of your business model. I can help you get there. I've been a CFO, business advisor, and strategist specifically for businesses for over 20 years. and I've done this for dozens of med spas. Our firm is business first. We're tactical, methodical, and we will create and implement a customized tax strategy specifically for you and your med spa with surgical precision. This is a done-for-you service, so you can focus on your business, on its growth and its profitability. Here's a list of what we will do for you. We will create a custom tax plan designed around your med spa and any other business interests you might have. We will handle the tax plan implementation. We will, as a product of that, include catch-up, cleanup, and reorganization of your books to conform to the tax plan for the year. You'll also have one-on-one strategy sessions with me as your virtual CFO. We will present you with a revised set of financial statements, your P&L, your balance sheet, your statement of cash flows to conform with the tax strategy that we've designed together. We will also recalibrate your quarterly estimated payments due to the IRS based off of the tax liability projections. We will also help you with any business tax preparation and individual tax preparation when the time comes, keeping in mind that our goal is to avoid having to file for an extension ever. I'd like to invite you to book a tax planning analysis call with me. The link below will take you directly to my calendar. Schedule a call with me on a time and day that works for you, and we will go through the following: your numbers, your previous year returns. Of course, we'll talk through your goals and focus on what matters to you, and I'll show you exactly how much I can save you on taxes and what strategies make the most sense for your business. I promise you, I will change your mind about bookkeepers, controllers, CPAs, and tax preparers forever. When you have a partner like me, you will be able to see your business in a completely different light through the lens of a CFO. My goal is to save you money on your taxes so you can grow and scale your med spa, so you can thrive and squash the competition.